Or not, this is the first time in 75 years that the former Fed chair Jerome Powell won't be stepping down from the Federal Reserve. And that means what happens next is going to determine whether or not your money keeps working for you or quietly loses even more of its value to inflation. Although before we start, I'll make you a deal. For every like and subscribe this video gets in the first 24 hours, I will do a push-up. Yeah, that's going to take me a very long time to do, but I got to get in shape for summer, and as a thank you for the motivation, here's a picture of a waffle. So thanks so much, and also big thank you to Surfshark for sponsoring this video, but more on that later. Alright, so in terms of what just happened, and why this is becoming such a major issue, we have to talk about the Federal Reserve. See, for those that are aware, the Federal Reserve is comprised of a small group of people whose entire job is to keep our economy stable. They do this by influencing interest rates, printing money, or siphoning
Russia, Iran, and arguably China, then a nuclear war. The strait being closed is their economic weapon of choice. So when they all sit down and say, yeah, Iran could never have a nuclear weapon, right? That is all just virtue signaling. It's all theater, and you're being told that Hollywood story. I believe the real story is that China and Russia are using Iran as a proxy, as a middleman to put pressure on the West so that they could get favorable leverage in this new monetary deal. Now, who actually benefits from this is Russia, Iran, and China, because the longer Hormuz stays closed, the more urgently the United States needs to make a deal before its financial markets get exposed by the reality of the broken supply chains. Right? And China now has enough economic power to buy themselves a seat at the table of this new global monetary restructuring. So this theory.
What's up, guys? It's Graham here. So this is pretty crazy. For the first time ever in history, the new chair of the Federal Reserve is openly calling for what he says is going to be a complete regime change at the institution that controls the cost of money in America. And if he follows through, this could reset everything from the Fed's balance sheet, how much it intervenes in the markets, the way they calculate inflation, and even the way interest rates affect your savings, investments, and mortgage. That's why we really got to break down exactly what's happening, why Kevin Worsh could wind up raising interest rates instead of lowering them, and how these changes are about to affect the very fabric of our economy. Because believe it or not, this is the first time in 75 years that the former Fed chair Jerome Powell won't be stepping
Or panic selling, but it is to say that this has been a 17-year trend. It's been happening for a long time, and they're not dumping it all at once because that would collapse the value of their bonds, and they wouldn't do that. That's why they're selling a little bit every year, but it's accelerating. And every time they sell a US Treasury bond, that is one less buyer in the market, which means the US has to pay more to find a replacement buyer. More supply, less demand means higher prices to borrow, right? That's China. Now, Japan is a different story. Japan is the biggest foreign holder of US Treasuries at around $1.1 trillion. And Japan has been selling them as well. But the reason Japan has been selling US Treasuries is because it desperately needs dollars. It needs dollars to defend its own currency, the yen, right? And it's because they need to buy oil as well. And that's why
actually impact your daily life. I'm talking savings accounts, mortgage rates, auto loans, investments, and so on, are impacted by something entirely different. The bond market. And right now, that bond market is in shambles. Why? Well, these long-term rates are completely dictated by market supply and demand. And if investors think there's going to be more inflation and more volatility in the future, they demand higher compensation up front for the additional risk. This means even if the Federal Reserve decides to cut rates tomorrow, your borrowing costs only fall if long-term investors believe that inflation is going down. And right now, they do not. In fact, as of right now, the market's beginning to price in the likelihood that Kevin Worsh is going to raise interest rates as his first policy move, mainly because inflation is growing out of control. The stock market is
across every asset class. And what that leads to is inflation, right? Inflation is not just a side effect of this deal. It might be the whole point, because the dirty secret of modern finance is that inflation is how you make unpayable debt payable again, but you inflate it away. A dollar of debt borrowed in 2020 gets repaid in 2030 dollars that are worth half as much. So the debt shrinks in real terms. And the way normal people experience this is through the price of eggs, rent, and gas. But inflation doesn't hit everyone equally, right? If you own assets like stocks and real estate, gold, Bitcoin, ancient gold coins, Pokemon cards, watches, whatever, inflation makes you richer. Your assets go up in what's called the nominal value, so you get protected. This is the top half of what economists call the K-shaped economy, the line that goes
paying the U.S. government paying more than 5% interest to borrow money for the next 30 years.
We're gonna be broke. I'm telling you it's gonna happen, and you're gonna panic.
What's up, guys? It's Graham here. So this is pretty bad. For the first time since the great financial crisis, bond yields have just risen above 5%. Mortgage rates are skyrocketing. The stock market's falling. And pretty soon, we could actually see the beginning of the unthinkable. A world where the safest investments in America become the biggest threat to everything else. Like, keep in mind, for the last 15 years, our entire economy was built on the concept of cheap money. Homes got more expensive because people could borrow more. Own thoughts about what's going on. Here's what you came for, because this could be the biggest policy change in decades. Honestly, here's my take. I tend to think the coverage around Kevin Worsh has been a bit dramatic on both sides of the equation. Like, the reality is, he inherited an economy with 3.8% inflation, $106 oil, a divided Federal Reserve, and a bond market that's already calling his bluff. On top of that, the market's not pricing in rate cuts anymore like we all thought a few months ago. Instead, it's beginning to price in the chance of a rate hike. And none of this regime change rhetoric is going to change the numbers unless inflation meaningfully comes down. That's why I tend to think that anyone who's waiting around for cheap money to come back is probably going to be waiting for a lot longer than expected. Now, in terms of whether or not any of this was Kevin Worsh's fault, my take is kind of. Like, on the one hand, he did enter the Federal Reserve in the middle of oil